Let me make sure I can hear. I'm gonna make y'all co-host.
Yeah, can you hear me?
Yeah, I had my computer on mute.
Okay, perfect.
Y'all good?
Yep.
Yep. I got everything situated. It's dope. Let's get it. All right. We're about to get started at 8. We got a lot of participants, so it's dope. But on the first day, we like to give you guys a few more. All right, here we go. They coming in. We're gonna start at about 8:01. All right. All right. Let me see if I got the other phone. Yep. All right, you guys. I want all of you who are in this room to share your screen to your story. Take a picture of where you are. Tag me in it. I will repost you. So everyone, reshare AMU Day 1 to your story and tag me in it. Me and Unraveler and AMU Money Mike. So if you guys know my Instagram, it's Aristotle_investments. Unraveler is Unraveler Trading. And AMU Money Mike is Mike's new Instagram. So tag us in your story. And yep, I'll give you guys time to do that. And then we're about to get the ball rolling. Hold up. What that just happened? Uh-oh, look at that. They tagging. Let's get it. Uh-oh, we got some more. All right. All right, so let's get started. So I am Aristotle. I am from Atlanta, Georgia. I have been trading since about like early 2017 options, but I've been investing since about 2016ish. So about 4 to 5 years of experience as far as looking at the market and whatnot. You see me, I'm Gucci down, not playing with them. I'm from Atlanta, Georgia. I've been in the military for 6 years. I started trading when I joined the military. The reason why I started trading options and promoting online was because I saw a way for people to make money. And that was the first time I saw that you can make money from your phone. Because what it was I was a barber in the Army and I used my barber money to trade options. So that's how I was able to scale my account quickly. I lived off my Army money and then I traded options with my barber money. So that is how I got into it. And I would invest about $3K a month of my barber profits into the market. And then that's how I was learning and whatnot. And then I met Mike and Unraveler. And we will discuss how we met after the class, because we like to say that for the grand finale. I know you guys are going to ask that. How did all three of us meet? But yep, I have a son, a wife. I'm a family man. And I enjoy teaching others the game of options and just overall wealth, no matter what it is. All right, I'm going to pass it off to my boy, Mike.
All right, how's it going, everyone? Welcome to AMU University. My name is Mike. I grew up in both Florida and New York, but I'm originally from Florida. I started to learn how to trade with my dad when I was 12 years old. And I don't mean like day trading, but more long-term investing and just basic finance, kind of understanding the principles of what it takes to become, a successful individual. I opened my first account in high school. I traded throughout high school and continued in college, where I studied in aeronautical science and finance, right? So I double majored in the two. So I'm actually a pilot also. I have a private pilot license with an instrument rating, okay? I traded throughout college and I really started making money, good money, my junior year in college. So my junior year in college is when I started becoming pretty profitable. And that's kind of when I started going full-time trading, but I had to keep going. I finished college. I worked as a member relationship specialist at a small bank in Florida. And then I continued trading and saving. So the entire time while I was working at the bank, I was continuing to trade on a daily basis. And then I wound up moving to New York for a little bit. So I worked in debt capital markets at a bank in New York, Japanese bank in New York. And in that field, while I was working in DCM and New York City, I made some connections with the other guys there who were also day traders. And we decided to create a little fund. So we decided to create a little hedge fund. I worked on that for about 6 months, where we raised the seed capital. You know, we were doing all the legal structure to get that ready to go and start having investors come into place. But then I decided it wasn't really the lifestyle for me. There's a lot of restrictions. It's not something that I really wanted on a daily basis to have to report to investors and always be on someone else's time. So that's when I decided I wanted to go my own way. I broke off from that and I retired in Colombia. So, I retired in Bogota, Colombia. I've been living in Colombia now for about 3 years. And I still trade every single day. It's what I do every single day. I day trade and I love it. It's my passion. I've been doing it for years, but every single day I wake up and I'm ready to go. It's a new challenge every single day. So my goal now is to help other people basically understand the dynamic of the market, the entire stock market and finance in general, and achieve the same financial freedom that I have today, right? So I'm excited for this month of AMU. I'm glad you guys have decided to come and join us. And I'll be passing it off to Unraveler now to introduce himself. Thanks, guys.
Thanks, Mike. Hey, everyone. Can you guys hear me? Yes? All right, perfect. So my name is Rohit. If you are from Aristotle's chat, you may know me as Unraveler. If you follow me on Instagram, you might have heard my voice, seen my face. Welcome to AMU University. So I want to introduce myself a little bit more. So I'm 28 years old and I live in the Midwest working as an IT consultant in data analysis, machine learning, and information systems. You all know I trade stocks and I've been doing it for so many years now. So I'm going to tell you a little bit about my journey as a trader. So back in college, I was always good with numbers, right? I was good in math, I was good in numbers. And like most people, I've always been fascinated by the stock market, right? You see all these guys making a killing in the stock market, making millions of dollars. So if you are good at numbers and if you know how to identify good risk and reward, you can take smart calculated risk. Basically, the market will award you, right? So I love the concept that you could buy something low and a few months later and sell it high and make a lot of money doing it, right? So I decided to educate myself and I started trading when I was in college, which was like 7 years ago now. So when I first started out, I wasn't doing options at all. So I was only trading stocks. I was trading small and mid cap equities, and I was pretty successful in making a decent amount of money after my first 6 months of trial and error, right? Back then I was young. I didn't focus on the psychological side of things. I didn't focus good on risk management, but I was making good money, right? I know I was doing something. I don't know how I was making money. I was just making money, right? But after graduating college, after, experiencing a lot of things in life, started working for a finance firm in New York City. And I was introduced to the world of options by some of my colleagues who are very successful in trading options. So I started learning more about options and I realized that I could apply the same technical analysis strategy that I use for trading stocks, risk a lot less money and make a lot of money in the process, right? So if you invest $100 and you could make $100, that's a great risk reward, right? So I decided to focus on trading options more. And I'm happy that I did because it allowed me to grow my accounts immensely over the years. A little bit about my educational background. I have a bachelor's degree in electrical and electronics engineering and a master's degree in information systems. So I'm very much a numbers guy and my trading approach is very technical, but I also incorporate fundamentals in my analysis when it comes to it. So I hope that this course helps everyone level up and takes that real next step in your trading journey. I'm sure a lot of you guys have tried different things. You must have done some kind of learning in your, you know, the last few months or last few years. But I hope that this course is that thing that clicks and helps you go to that next level. Okay. And I really hope that we help you take that next step and start your journey as profitable traders. Good luck and happy learning. Pass it off to Aristotle.
All right. Unravel, you finished?
Yep, all you.
All right, let's get it. So by the end of this course, you will know how to day trade and swing trade confidently, control your emotions while trading, be consistently profitable, and unlike other courses, we are giving you everything instead of the basic needs to know, right? Now, let's hop right into it. Stock market terminology. Stocks are the capital raised by a business or corporation through the issue and subscription of shares. Shares are pieces of the company that you own outright with no expiration. Buying shares makes you a shareholder, correct? So if I was to buy a share of Apple and Apple is priced at, let's just say $130, buying Apple shares makes me a owner forever, a shareholder, correct? Unless they delist from the stock market. So bulls strike up, bears strike down. So the reason why we use the terms bullish and bearish is because in the stock market, we're using the animals fighting attack styles. So remember, bulls strike up, bears strike down. So if we're talking about a bull market based on fighting attack styles, we are talking about a stock market that is in a prolonged period of increased prices. If we're talking about a bear market, we are talking about a stock market that is in a prolonged period of decreased prices. Now, bulls, the buyers, this is referred to as a term that gives a name to the people who are pushing prices to go up. You'll also see the term bullish, which also means prices are going up. And then you'll see the term bears, which means the sellers. This is given to the name of people who are trying to push prices down by selling their stocks. The term bearish means that prices are going down. So we're about to see an experiment here. Now, let me see. I want all of you guys to tell me where you're from. All right, tell me where you're from. Texas, Seattle, Atlanta, Charlotte, Chicago. It's a lot of you. Hawaii, New York, Philly, Florida, all that, right? So you guys are from everywhere. Sheesh. Oh, man. Wow. Okay. So now that I see where you guys are from, you can see the time zones we will be trading in. So Eastern time zone is the time zone that I am in. I believe Mike is mostly in because he is in the country of Colombia mostly. So he's on the Eastern time zone as well. Unraveler would be on the Central time zone because he lives in Wisconsin, somewhere in Wisconsin, right? And then we got 7:30 to 2:30, which is a okay time zone. I believe any time zone has its perks because I can see perks with California time because from 6:30 to 1:30, I remember when I was trading over there, I was able to finish my day earlier, but I got less sleep. You see what I'm saying? So they sacrifice sleep for an earlier day and a more productive day. And then so I do enjoy trading on that time. And I also enjoy trading overseas in Greece. In Greece, the stock market opened at 4:30 during the day. So I could literally get a whole bunch of work done during the day, and I could still trade for an hour and then enjoy my day. Now, granted, Greece only got tough when it was time for me to do AMU at night live, because I had to wake up at about 2 o'clock. Yep. Yep. At about 2 o'clock during the day, at night to do AMU. So let's go over some basic stock market terminology that I want all of you guys to know, because this is day one. So a trade is simply when you buy or sell a stock. Day trade, buying and selling a stock within the same day. Swing trade, holding a trade overnight. So holding a stock overnight means swing trading. Long, if I say I'm long on a stock, I am bullish on the stock. I think it's going up. If I say I am short on a stock, I am bearish on the stock. I think it's going down. A call option. A call is an option trade that bets on the stock to go up. A put is an option that bets on the stock to go down. Now remember, shares. Shares are pieces of the company you own outright with no expiration date. Dividends are portions of a company's earnings that is paid to shareholders. So I know you guys hear me preach dividends all of the time. And in AMU, we are mostly focused on trading, but yes, we do teach fundamental analysis and long-term trading, because I personally do it. Mike personally does it. A lot of us personally do. I use dividends to invest a lot of my profits, right? I use my profits to invest in stocks that pay dividends. So I love dividends. And then volume is the number of shares of a stock traded during a particular time period, normally measured in average daily trading volume. All right. So common lingo used. So when you are in the stock market, these are common terms you're going to use, right? And you're going to hear me use, and a lot of us use. Scalp is a quick day trade. So when we say scalping, right, we are talking about a trade that lasts for no more than 3 minutes to 5 minutes. But usually it could really last from seconds to like 5 minutes. But after that, it's usually considered a day trade. So if someone says they're scalping something, usually they are entering the position with a large size. So let's just say I wanted to scalp Tesla, correct? I would enter with something like $10,000 just to make a quick 2,000 or 1,000. So that's the whole name of the game with scalping, and why we love it so much, and why we will teach you guys how to do it, is because we will teach you guys how to trade with, or our strategies on trading with large size, but getting profits like 2,000, 1,000. So it's all about that. And then swing trading, of course, is an old school style, and that's more for people with smaller accounts who want to get more from their money. And then take profits is something we use saying sell your position, take profits. Buying power, for those who are using cash accounts, how much money you have left to spend on a stock. We say hold something, of course, that's, you know what that means. And then long, remember, long means bullish. It means we're bullish and we're long on the stock. And then gap, which we will, I think Mike will talk about how to trade gaps in empty space where there are no contracts or shares traded. You will see stocks constantly gap up or down. And then, of course, call, put, shares, ER, earning reports, HOD, high of the day, LOD, low of the day, and then FOMO, fear of missing out, which you will hear a lot in the stock market. You will hear the term FOMO. And then you will hear the term 0 day to expiration. And that means we are trading Friday, or like on rare days, like let's just say Friday is off and it's on a Thursday, then you will be trading 0 day to expiration Thursday contracts. But more than likely, 9 times out of 10, you will be trading Friday contracts known as 0 day to expiration, meaning you're trading Friday contracts on a Friday. And we will explain why that can be dangerous or beneficial. And then we want to talk about risk management, which we will go over at the end of the course, because we want you guys to leave out with risk management. Risk management is the whole key to success of trading. So I can teach you guys all these chart patterns. I can teach you guys all these different things, right? But if you cannot control your money, and if you're very greedy, or if you play too scary, all of those things go into risk management. And we will be explaining that later in the course. So fundamental analysis and technical analysis will be the two ways and the two styles that we will be teaching in this course. So technical analysis is all about the graphs and charting. That is how we make 99% of our money. But fundamental analysis is just buying and holding and looking at balance sheets and all of that, right? So technical analysis is what we will be using in order to teach you guys all of what we know. So financial analysis that uses patterns in the market data and identifying trends and make predictions. And then fundamental analysis is what we'll be teaching on day 5, and we will be explaining to you live how to read balance sheets and all of that. So technical analysis, remember, is price trends, candlestick patterns, supply and demand, moving averages, indicators, and then we are anticipating short-term price moves. So the reason why we use technical analysis is because we're trying to make money in the shortest time frame as possible. Okay. In fundamental analysis, fair pricing is key. Traders are looking for stocks that are undervalued or overvalued. Extrinsic value is something we will be going over, and we will be showing you guys how and hacks to looking for good, profitable companies to put into your portfolio, because I am a firm believer in long-term trading and option trading and in all aspects of trading. So conclusion, I will be passing it off to Mike, or Unravel. I think it's Mike. I will be passing it off to Mike. I hope you guys enjoyed day 1 of AMU from Aristotle. All right. And that is it. That is.
All right. How's it going, everyone? Welcome to AMU University, week 1, day 1. So today is a lot of introductory stuff. Don't worry if you've already been trading for a while. We're going to get very advanced and talk about everything you have to know about trading. But today, week 1, day 1, AMU University. Before I get started, I just want to make sure that everyone can see my screen and everyone can hear me well. Okay, perfect. All right, so let's go ahead and get started. Expectations. Let's go over some expectations first for AMU, okay? So will you become rich the day after taking AMU? No, that's something you should take out of your head, okay? AMU is a course designed to help you guys become successful traders, kind of get you into the game and get started on a way more advanced scale than anyone else who's starting this. But you won't just become rich automatically the day after taking it, okay? Will you still need to put in work on a constant basis after taking AMU? Yes, of course. All 3 of us, even though we're successful day traders, we've been trading for years, we still come up with new strategies. We're still working on a daily basis to figure out what can we do better to, better ourselves, better our trading, and figure out what we did wrong, okay? Will you learn a lot and build a foundation to becoming a successful trader after taking AMU? Yes, 100%, 1,000,000%. This is the best course you can possibly take to take that jump and become a successful trader, right? So AMU is a course designed by 3 successful traders, all from different backgrounds. Our goal is to give you a foundation to becoming a successful trader, whether you are a beginner or you have already been trading for 2 years, okay? So whether you have some experience already under your belt or this is brand new to you, you've never traded in your entire life, well, AMU is designed to help you, whether you start from zero, you've already have some experience, okay? So take notes, pay attention. There's a lot of stuff that we're going to be going over, but we have an entire month with you guys. So that's the difference between AMU and some of these other stupid courses you see online, right? We're spending an entire month, all of August. You guys have us to ask questions. You have us. We're going to talk about our strategies, everything that you need to know to take that jump, become a successful trader, okay? So take notes, pay attention to these classes, and welcome to AMU University. So quick basics. These are just some rules I like to start with. I'm going to say them on day 1, and I'm also going to say them on day 12. So the last day of class, I'm going to say the exact same rules. I want to put them in your brains right now so you understand what it takes to get to that level. What does it take to be consistent, to be profitable as a trader, all right? These are the key basics. Trading less is more, okay? So you don't want to overtrade. You don't want to try to look for 5 or 10 trades a day. You really want to focus on the most high probability trades you possibly can, okay? So whether that means trading 1 time throughout the entire week or 1 time a day, that's what you want to focus on. You want to focus on the most high probability trades throughout the day or whatever, throughout the week. If it's not high probability, if there's not something on your screen that screams at you, oh, this trade looks good, then you can't take it. So trading less actually means more to your P&L. You want to take less positions to make more money. Focus on the big picture, okay? So the thing about trading is it's absolutely impossible to avoid losses. So you're going to have losses, but you have to focus on the big picture. You can't focus on day to day, okay? So what I want you guys to start doing, starting from day 1, is try to be profitable on a monthly basis. Try to have a green week first, okay? So start trying to have a green week, and then once you do that, try to have a green month. Once you do that, and you can actually have a green month, try to go for a green quarter. Go 3 or 4 months on the green, on your P&L, okay? So focus on the big picture. Don't focus day to day. If you have a down day, that's fine. You can recover from it, okay? Start small and build your way up no matter the account size. So I don't know how many of you guys are starting with $1,000. I don't know how many of you guys are starting with $50,000, but you always have to start small no matter how much money you have in your account right now, okay? Start with 1 contract. Start trading with 1 contract until you're consistent for a month. And then maybe you can start jumping up or trade 100 shares instead of 1,000 shares, okay? So start really small. Trade 1 contract. Once you get that, you start becoming consistent for a month, jump it up to 2. If you can do that for a month, jump it up to 4. And you can keep doubling. You can keep increasing your position size as you are consistent. But if you're not consistent, stay small, okay? It's not worth it to blow up an account just because you're trading large size and you have like some sort of crazy confidence in your head that you shouldn't have. Until you are 3 months, that's the rule I always tell people. Once you're 3 months consistent, that's when you can really start adding on some size, okay? Every trade should have a plan with an action, all right? So tomorrow you're thinking about trading Apple calls. You're thinking you want to trade Apple because they had really good news overnight or whatever, and you want to take a bounce off the bell. Well, that trade should have a plan with an action, okay? So the action being a stop loss and a take profit. Before you get into a trade, you have to kind of understand where you're thinking to take profit. profit and where you could potentially stop loss if it goes against you, okay? So you should have a plan. Don't take boredom trades. Don't take trades just because you have nothing else to do. Every trade should have a plan, all right? So once you're thinking to enter something, make sure there's reasoning behind it. And this is something I'll say probably 20 times throughout the entire course. Focus on the stock with the highest volume, clearest trend, and most aggressive buying or selling. Now, that may not mean a lot to you right now if you don't understand what volume, trends, and aggressive buying or selling is, but it will throughout the course. I'm going to show you guys what does volume do, how does it affect stocks. Unraveler is going to show you guys how to indicate trends, okay? And I'm going to show you aggressive buying or selling when I go over times and sales in level 2, right? But just, this is a very important sentence, and I'll say it 20 times throughout the entire course, but these are your basics, right? So if you guys want to become consistent, you guys want to become profitable, okay? These basics are going to help you, and I'll repeat them at the end of the course, okay? So let's go ahead and get started. Cash versus margin account. When you guys go day one, right? I don't know how many of you guys are on day one or you've already been trading for 2 years, but if you're on day one, you're going to have to choose. You're going to have to choose. Do you want to open a cash account or do you want to open a margin account? Most brokers will give you the option. So a cash account does not have a restriction on how many day trades you can make. You can trade the funds available in your account until they are no longer available. Shares take 3 days to settle, while options settle overnight. After the cash is settled, you may trade with those funds again. So what does that mean? What does settling mean? I've never heard that. Okay, here's an example. If your account has $1,000 in it right now, you have a cash account. It has $1,000 in it, all right? You buy an Apple call tomorrow, and that Apple call costs you $300. You now have $700 to trade with for the rest of the day. So you're just subtracting the 300 from the 1,000, and you have $700 now to trade with for the rest of the day. The next morning, the profit or loss you took on the $300 Apple call will be ready to use again. So let's say you day traded that $300 call and you sold it, you made a profit of 50, right? So you sold for $350. Tomorrow, if today's Tuesday and tomorrow's Wednesday, tomorrow I now have $1,050 to trade with in my cash account. Overnight options settle on a cash account, okay? So the profit or the loss that you took, let's say you took a $50 loss, right? You sold it for $250, same day. Well, tomorrow's Wednesday, now I have $950 to trade with, okay? So the next morning, the profit or loss you take on the position will be ready to use again, right? So that's a cash account. A cash account, you basically have access to all the funds in your account until you run out, right? So if you buy, let's say the Apple call is $250 and you have $1,000 in your account, you could trade that up to 4 times, right? Because 250 times 4 is $1,000. You could trade that up to 4 times in a day. And then the next morning, whatever profit or loss you take on those day trades is going to reflect in your account, and that's what you'll be able to trade with for the entire day. Margin accounts, on the other hand, under $25,000. So if you open it, if you decide to open a margin account, which it's your choice, the broker will give you a choice. If you do open a margin account and you have less than $25,000, you will be restricted to 3 day trades within a 5-day period, okay? That's a FINRA regulation. There's no way to get around it, okay? It's a financial regulation in the United States. If you have less than $25,000 and you open a margin account, you can only make 3 day trades, which is buying and selling a security within the same day or an option, right? If you have under 25,000, then you will be restricted to 3 day trades within a 5-day period. If you open a margin account and you have over $25,000 in that account, you have unlimited day trades. So you can day trade all day long as much as you want in that account. Margin accounts also allow you to borrow money in order to leverage positions. So for example, TD Ameritrade has 4 times margin on equity or shares. So let's say your account balance is $25,000. you could enter into $100,000 equity or stock positions on margin. So most brokers will give you that option. If you have a margin account, you can actually enter into four times margin, right? So if you have 25,000, you can enter into $100,000 day trade equity or stock positions. Okay. So which is better and why? Very simple. If you have less than $25,000 ready to go, whether you already have an account or you don't have an account, if you have less than $25,000 for trading, open a cash account. If you have over $25,000, open a margin account. Very simple, okay? Less than 25,000, open cash. And if you already have an account and you don't know if you have a cash or a margin account, then you can either call or message on the chat to your broker and ask them, hey, do I have a cash or a margin account? If they tell you you have a margin account and you only have $1,000 in your account, you can write to them or you can call them and you can say, hey, I would like to change this to a cash account, okay? And that way you'll be able to day trade more. Because like I said, with a margin account less than 25,000, you will be restricted by law to 3 day trades within a 5-day period, right? So less than 25,000, open a cash account. More than 25,000, open a margin account. Very simple. So let's look at some brokers, right? You guys, I don't know, maybe you already have accounts, maybe you don't, but let's check out some brokers that you could potentially use. TD Ameritrade, this one is very, very popular, right? A lot of people in Aristotle's chat, a lot of people, whatever, retail brokers love TD Ameritrade. It's also called Thinkorswim, all right? Thinkorswim is the platform that you can download. It's very, very popularly used by retail traders. It allows cash and margin accounts, all right? You can trade both options and stocks. It's an amazing platform and interface that comes free with the account. And I'll actually be showing you guys how to use the platform. I'm going to show you guys exactly how to use the Thinkorswim platform. I'm going to show you everything that you can possibly do. There's a lot of cool secrets on there. Most people don't even know about it, right? So I'm going to show you guys how to use Thinkorswim TD Ameritrade platform. It's very easy. They also have a mobile app. The mobile app you can download from the App Store. It's called Thinkorswim. It's very easy to use. It's $0 commission fee for stocks. So you don't have to pay commissions if you're trading stocks. So like if you buy a share of Apple and you sell a share of Apple, you won't pay any commissions on that. So that's a cool bonus. It's variable commission for options, depending on account size, but it typically starts at 65 cents per option contract. So it depends really what your account size is and how long you've been trading with TD Ameritrade. But if you guys have a large account size, like really anything over, I don't know, 25,000, then you can text them on the app, on the chat, on the app, or you can call them and ask for lower commissions. So their commissions are variable. It really depends on the account size you have and how long you've been a customer, right? But typically 65 cents per option contract, which isn't that bad. The only problem that I've seen with TD Ameritrade recently, and this was back early 2020, I don't know if they still have this issue, but it was declining in speed and reliability. So off of the bell primarily, the speed, they wouldn't really fill the orders that fast. So like the first 15 minutes of the day, I had a lot of trouble getting filled on my orders, right? So that was a negative. And the customer service sometimes was slow and not helpful. So sometimes I would be on hold for 45 minutes waiting to talk to someone on the trade desk, which is that's not good for me, right? I like to be able to pick up the phone and call someone, right? But overall, TD Ameritrade is a really solid platform. There's a lot of features on there. I'm going to show you guys how to use them. TD Ameritrade is really solid. Starting out, I do recommend TD Ameritrade Thinkorswim. This is what it looks like. So if you guys have the Thinkorswim desktop application, you can see what it looks like here. This is how I had it set up. I don't use them anymore because like I said, they had a lot of problems kind of like late 2019, 2020 with the speed and reliability. So I stopped using them, but this is what the platform looks like, right? So you can see all the different features and functions that it has. Like I said, I'll be going over this live. So I'm literally going to this platform and I'll show you guys how to use Thinkorswim. but this is what, just a little screenshot of what you can make it look like. It's very advanced. Tastyworks is another good broker that I hear a lot about. So it has options and stock trading as well. Great execution and customer support. I've never heard anything bad about their execution. Platform is a little basic to me and confusing to some. I mean, at least from my experience, I'm not going to talk about every single broker because I haven't traded on every single broker, and I don't want to talk about brokers that I don't have experience with. But Tastyworks, I know I did use it in the past for a little bit, and the execution was fine. I know the platform was a little basic, but I've never heard a lot of bad things about it. So this is another option if you're starting out, Tastyworks for sure. And then it's $1 per contract option commission. I think that's capped at $10. Okay. Lightspeed, this is what I personally use. I use Lightspeed Trading. It's a beautiful platform with access to level 2 and times and sales, so you can get a lot of market depth. It has a short locator to locate hard to borrow stocks to short. Execution is direct to market. So the thing about Lightspeed is that I'm directly routing to whichever ECN I want to. Okay, and I'll explain that later. But literally, I'm not trading through a third party. I'm trading directly to NASDAQ. I'm trading directly to BATS, whatever it may be. I'm executing directly to the market. Okay, so there's never, ever a lag. I've never had a problem entering or exiting a trade. You can route your orders to the ECN you choose. Okay, and I'll explain that later when I go over level 2 and times and sales. Okay. But Lightspeed overall is an amazing platform. 60 cents per option contract and 0.004 cents per share. Now the downside, Lightspeed honestly is a professional broker. Their target audience is to elite traders or hedge funds or larger firms, okay? So their account minimum is $25,000. That's their absolute minimum. You can't open an account with them unless you have $25,000. And they don't offer paper trading. They don't offer any of that stuff, okay? So Lightspeed is a very serious platform. And this is what it looks like. This is just a little screenshot of how I have mine set up. So you can see like the level 2 up here at the top left in the books. So these are the NASDAQ and ARCA books down here at the bottom. I have my times and sales in the middle, as well as my order entry. So I can get into equity positions here or option positions down here at the bottom. And this is where on the top right, it'll show you orders and positions. That's where it'll show up when I get into something, and just a little chart there at the bottom. So that's what the platform looks like. It is a very professional broker. I mean, if you guys want to check it out, go ahead. I mean, if you have the 25,000, if not, note it down, write it down. And once you get to that level, once you get to 25,000, once you're starting to become pretty profitable, then yeah, Lightspeed is an amazing broker, okay? Robinhood, this is another popular one. It's very simple user interface. It's $0 commission fees on stocks and options, so you actually don't have to pay commissions. When you trade with Robinhood, you don't have to pay commissions, and I think that's the best upside possible, okay? Other than that, horrible customer service and horrible execution and lag, all right? This is not a broker you want to day trade with. This is not a broker I would ever consider executing large position sizes with. Robinhood is a joke when it comes to that aspect of trading, okay? So there was actually a shirt. I don't know if you guys were around trading in March of 2019, but there was a shirt that was made that says, I survived the Robinhood crash of March 2019. Because Robinhood, it's a broker, right? It's the same as all those other ones. And for an entire day, for like 36 hours, no one could get onto their broker. People had open positions. They couldn't sell out of their position. So people lost hundreds of thousands of dollars, and no one could even get onto the platform. No one could get onto Robinhood. It was shut down for an entire day, more than a day, okay? Horrible customer service. I remember there's not even a number you can call. That's the problem with this broker. You can't talk to anyone, okay? There's not a number you can call. It's all through email. And I remember that day. After, I know people who lost thousands of dollars, and Robinhood sent out emails, hey, we'll compensate you with a Walmart gift card. Okay, that's trash customer service. And also, what kind of broker is that? Okay, so I don't recommend for day trading. It is okay for swing trading because it's $0 commission fees on stock and options. If you want to buy something right now on Robinhood and sell it a year from now, go for it. Go for it. That's fine. But do not day trade with Robinhood. Do not day trade with Robinhood. Okay, I promise. If that happened in 2019, I'm sure it can happen in 2021. Don't trust it. Now, before I leave today, I just have a little summary of something I'll be going over in a couple of classes. Just a little summary of fundamental analysis so you guys can get a little insight of what we'll be going over this entire class. We're going over everything, right? From day 1 to day 12, we will literally be talking about everything possible when it comes to finance and the stock market and options trading and equity trading, all of it. So fundamental analysis is the stock market analysis of breaking down a company's financial information to find intrinsic value versus market value. It requires an in-depth study on a company's past performance, present performance, and future expectations. Yahoo Finance provides a great rundown on every company's financials, a balance sheet. So Yahoo Finance, the free webpage, you guys can go to it. And this is where I literally got this picture from. So up here at the top, you can see, I'm going to show you guys this very in-depth income statement, balance sheet, cash flow, right? Total revenue for the company. There's a annual income statement because you can see 2016 to 2019. You have your revenue, your gross profit, but I'll be breaking down all of this, okay? Just a little sneak peek of everything we'll be going over. Anyway, hope that made sense. And this is just day 1, all right? We're going to be going over a lot of information. Don't worry. I have a lot of stuff planned. We all have a lot of stuff planned. It's going to be a great month. I'm excited. I'll be passing it off to Another now.
Thanks, Mike. What's going on, everyone? Good evening. Welcome to AMU University, day 1, week 1. Can you all hear me? Hello, hello. There's a lot of people tuned in today. I see a whole bunch of people from all over the world, in fact. Hello. So, welcome to AMU University, and today is day 1, and I'm really excited to kick things off here today. And today's topic is going to be very, very interesting, right? So, how many of you have already been trading? So, who's trading? Who has some trading experience here? All right. Who has options trading experience here? All right. Who's absolutely new? Okay, I can see a lot of me here. Okay. So fear not, today's lesson, like Mike and Arshad will mention, is all about getting your feet wet, right? So we're not doing anything crazy today. So we are going to learn the basics. And I'm here to give you an introduction to options trading. So what is options? What is it all about? And even if you've been trading for a while, right? Some of this information is going to be very, very important and useful for you, right? So even if some people have been trading for years, they might have forgotten some of the basics, right? So I know, for example, I did engineering and computer science. Sometimes when I read some old stuff, hey, I almost forgot about this, right? You get this throwback, right? So it's going to be an interesting lesson. I'll be monitoring the chat. Pay attention. And if you have questions, feel free to type it. And I'll see your questions and I'll answer it then and there if it's relevant to the topic. Okay, let's get started. Can you all see my screen? Okay, so some people cannot see a screen. So this is a Zoom issue. So if you can't see my screen, right, there is a way to fix it. You have to log off and log back in, right? If you can't see my screen, my PowerPoint, just log off and log back in and that will fix the issue. All right. Okay, All right, so let's get started. So day one, introduction to options trading, right? All right, I'll give everyone 10 seconds. So log off and log back in. Since this is the first class, I'll wait. Okay, someone's doing a countdown. That's funny. Okay, so some people are back. Okay, it fixed it. All right. So 3, 2, 1, just complete the countdown, whoever was doing it. All right, there we go. All right, well done. So introduction to options trading. So let's see what we're going to learn today. Table of content. First, we're going to learn about financial instruments, right? Don't worry, it's not going to be complex at all. And then we're going to learn about options. What are options? The characteristics of an option contract, the different types of options. Then we're going to jump into a slightly advanced concept called as writing options. And then lastly, why we trade options. Someone just said, let's get to the bounce place. Patience, patience. Okay. Financial instruments. So what is an instrument, right? They are a means to an end. So if you want to make music, you need a musical instrument, right? You need a guitar or a piano or whatever, right? If you want to watch a movie, you need a television set, right? Without a TV, you can't watch movies, right? And similarly, to transact in the financial markets, that is to participate in the financial market as a stock market, you need a financial instrument, right? An instrument is a means to an end. To do anything, you need something, right? A financial instrument is nothing but a financial contract between interested parties. They can be created, they can be traded, meaning exchanged, they can be modified, and lastly, they can be settled, right? So in a nutshell, if someone out there from the finance world says, what financial instrument are you trading, right? Financial instrument is nothing but a means to exchange money in the market, okay? Now, financial instruments can be cash or derivative instruments, right? I just said that financial instrument is nothing but a way to exchange money in the market, right? So they can be cash instruments or derivative instruments, right? So what is a cash instrument? Cash instruments are those that the markets value directly, right? So cash instruments are those that the markets value directly. What do you mean by that? Stocks are considered cash instruments. So let's take a company, everyone's favorite company, Apple. Okay, maybe not everyone's favorite company, but most people's favorite company, Apple, right? So Apple is actually a stock. So Apple's price, I think it was currently flirting today at around 148, right? The stock price of Apple, the market valued it, right? So who decided Apple's stock price is worth 148, right? So the market's going to decide that. Based on what, you may ask me? It could be based on their income, right? It could be based on their revenue that they're earning. It could be based on their future projections, right? It could be based on how much cash they're holding, right? It can be based on anything, right? It could be based because everyone likes the new iPhone. It could be based because they like Steve, they like Steve Jobs, right? Whatever, right? Could be anything. You don't need to know the reason. I don't need to know the reason. The markets collect every bit of information and it's going to value it. 148, right? People are willing to pay 148 for Apple. Boom, that's the stock price of Apple, right? If people think that it's not worth that much, then supply is going to be greater than demand. So people are going to sell Apple. There's a bad news or whatever, right? Then the stock price is going to drop, right? So what I'm trying to say here is that cash instruments are those that the markets value directly, okay? That's why stocks are considered as cash instruments, okay? You and I, we play a part in the jigsaw puzzle, but we don't decide that. The market decides that, okay? Now, next is derivative instruments, right? What is a derivative instrument? Derivative instruments, like the name implies, derivative, right, are those that derive their value from movements of an underlying entity such as stocks, bonds, etc., right? So they derive their value from something else, meaning they don't have any value of their own, right? Example, options, future contracts, etc., right? So think about it. Apple, the same company, right? Apple is worth 148 right now, right? Now, let's imagine an option contract. You don't know what it is. So some people are new. You don't know what option contract is. But let's say you have an option contract for Apple, right? Now that call option contract itself does not have any value on its own. But when the stock price of Apple moves, right? If Apple goes to 150, it goes to 151, 152, right? Then the value of your option is going to derive its value from the stock and it's going to base its value on that, right? So if you have a call option and the stock goes up, then your option also goes up. If a stock goes down, then the option also goes down, right? Derivative instruments derive their value from something else, okay? Options fall under that category, okay? So just to recap, right? An instrument is nothing but a means to an end, right? If you want to transact in the stock market, you need to have an instrument, and that instrument is what we call as financial instruments. So in Wall Street terms, right? People will ask you, hey, what instrument are you trading? Are you doing bonds? Are you doing stocks? Are you doing options, right? They like to use all these jargons, but it's nothing but a means to an end, right? You can trade any one of these asset classes, right? They're nothing but financial instruments. Cash instruments, they have their value of their own. Derivative instruments, they don't have any value of their own. They derive their value from something else. Okay, is everyone clear? Following? Yes. This is nothing. This is easy. Just simplify these concepts, right? It's all, you know, there's simple things. All right. Next. So we just discussed that option fall under the category of derivative instruments, right? So what are options? Option is a derivative instrument because they derive their value from the stock. Option is a derivative instrument that specifies a contract between two parties for a future transaction on an asset at a set price within a specific date. Now that sounded like a puzzle when I was reading it, right? I'm sure you wouldn't have understood what I just said, right? So what is options, right? So let's break it down. What is an option contract? An option is a contract that gives the buyer the right but not obligation to buy or sell the underlying asset or security at the agreed price within the agreed time. Now that doesn't make sense also. So let's come break it down even further. So let's take two friends, right? Barry and Sam, right? These guys look like they're friends, right? One has a bigger beard, one this small beard, kind of like a goatee, right? So anyway, so Sam is a guy who likes to scalp sneakers. He scalped the new Travis Scott sneakers, right? He's selling it everything for $5,000, $10,000, right? He's a crazy dude. He ruins people's lives by, you know, by buying all the sneakers, right? So anyway, he bought a sneaker from StockX or whatever website, and he's trying to resell it. Okay. Now Barry is his close buddy. Okay. He wants to buy the sneaker for $300 by the end of September. Okay. So wants to buy the sneaker. Let's assume that the sneaker is current value is 300. Okay. Let's say that the current value of the sneaker is 300. Okay. And Barry wants to buy the sneaker for $300 by the end of September. Okay. Now that's the deal that they have in place. And Sam has agreed to do that. All right. He says that, hey, if you're willing to give me $300 by the end of September for the sneaker, you can buy it from me whenever you want. Okay. Is everyone clear on that? Now let's come back to this. Now this is a contract between Barry and Sam. An option is a contract that gives the buyer the right, but not obligation. Meaning Barry has the right to buy the sneaker for $300, but is under no obligation to do so, right? If tomorrow there is or 2 weeks from now, there is a new Yeezy sneaker drop, right? Then Barry no longer wants this Travis Scott sneakers, right? He wants the Yeezy sneaker, right? Okay. So he wants that sneaker. He does not want the Travis Scott, right? So an option is a contract that gives the buyer the right, but not obligation to buy or sell. So in this case, we're talking about buying, okay? The underlying asset or security. The asset or security in question now is a sneaker, but if we replace that with a stock, that's what we're going to talk about in the market, right? In the market, we're not going to be trading sneakers. We're going to be trading stocks, right? So an option is a contract that gives the buyer the right to buy or sell the underlying asset or security. In this case, it's a sneaker at the agreed price. The agreed price is $300, right? It's a financial contract, right? All financial contract has a dollar amount tied to it. And in this case, it's $300, right? Within the agreed time. There is always a time constraint regarding contracts. No contract is indefinite, right? So in this case, the time constraint is end of September. Now let's read the definition again, right? An option is a contract that gives the buyer the right but not obligation to buy or sell the underlying asset or security at the agreed price within the agreed time. So basically, Barry has the right to buy the sneaker for $300 by the end of September. Okay. Now, you may ask me, why can't Barry just go to Walmart or something and buy the sneaker, right, for 300? Okay, maybe not Walmart, like whatever, like Foot Locker or something, right? Why can't he just go to the store and buy it, right? He can go to the market and buy the stock. Why does he need a contract? Why complicate things, right? There is a catch, right? So let's say that a week from now, right, LeBron James or some other famous basketball player decided to wear the sneaker for an event, right? And immediately, since that famous person wore the sneaker, the value of the sneaker just shoots up, right? Since that person wore it, oh my God, this $300 sneaker is worth $3,000 now, right? I don't know, the market is crazy, the world is crazy, so suddenly it's worth $3,000, right? Everyone is paying like 10x retail to buy that sneaker, right? Now, Barry does not have to pay $3,000 to buy that sneaker because he has a contract with Sam that says, hey, you agreed to pay me, you agreed to sell the sneaker to me for $300, so you have to do it and I want it now. You guys starting to get the drift, right? Now replace sneaker with a stock, right? Apple stock is 300 right now. Let's assume that. Now Apple released the new iPhone and their sales just skyrocketed, and Apple stock is just soaring and high, right? It's like 350, 400. It just keeps going up. Now, since you have this contract, you don't have to pay 400 for Apple because you have the right to buy it for 300. Okay, that's why it gives you that's why options are powerful, especially because you have a fixed contract. Even if the value of that asset soars, you have the right to buy it at the price you set in the option contract. Okay, that's the power of option. That's why we do options trading, but the real reason for options is this is the real reason, right? You have a contract, you can honor that, you can use that contract and get the seller to honor their agreement, buy or sell, whatever. Okay, so key takeaways here, right? The option contract buyer pays for the right to complete the transaction, but it is under no obligation to do so, right? So Barry may like the sneaker today. 2 weeks from now, he may like an Adidas sneaker or a Yeezy sneaker. So he does not have to buy this. He has the right to buy it, but is under no obligation to do so, right? So that's why when we buy option contracts, right? So we buy like hundreds of contracts every single day. We don't have to buy the stock every time we buy an option contract. We just have a right to buy it, but we don't have to do it, right? That's why it's called an option, right? Hence the term option. Okay, an agreed price. So all option contracts have an agreed price. So in this case, it's 300, and this is what we call a strike price, right? So this is the price at which the option buyer can buy or sell the underlying security, also known as option strike price, right? So $300 is the price of the sneaker, is the strike price. It's the agreed price. That's why we call it as the agreed price and the time price constraint, right? And next is agreed time. This is the expiration date for the option contract, right? Like I said, all financial contracts, right, have a deadline. In this case, this is what we call as agreed time and expiration date, right? And the option buyer has the right to exercise their option by this date, right? So exercise meaning exercise the right of buying and selling, all right? So $300 sneaker, if Barry wants the sneaker, he has to exercise his right to buy the sneaker. That means he has to execute his contract, okay? That's pretty much it, guys. I mean, people complicate options a lot, but it's basically giving you the right to buy or sell based on the contract that you bought, okay? Is everyone clear? And again, so if any of these concepts you don't understand, don't worry, you will not be alone, right? These are fairly straightforward, but you will face some concepts where you don't understand from the get-go, right? Don't feel bad, don't feel anything. We've been doing this for years, so everything seems easy, right? All you have to do is rewatch the lesson, ask questions, and boom, you'll get the answer that you seek. Okay, so don't worry if you don't get anything from the first try, right? It's totally normal, right? You're not supposed to understand everything from the first go, right? We've done doing this for years, so that's why we're clear. If you understood this from the first go, you guys are great, right? You guys are already better than us, okay? Better than we were, right? So some things, characteristics of a stock option contract, right? Now, there are a few more terms that you need to know, right? Before you jump into options, right? There are certain things that you absolutely have to know, right? First is the strike price. right? So what is the strike price? I already mentioned it. All stock option contracts can be associated with a strike price. This example, the agreed price, $300 is the strike price. Okay. This is the price at which the option holder can either buy or sell the underlying security, depending on the type of option contract, right? So Barry wants the sneaker, he has to pay 300, right? Same thing. That's what we call a strike price. Next, contract size. Now, this is something you have to pay attention, okay? So what is contract size? This refers to the fixed unit of shares that each option contract holds, right? The contract size for a stock option contract is standardized at 100 shares. Now think of it like this, right? One option contract is equal to 100 shares, right? So if you have one contract of Apple call option, that gives you the right to buy 100 shares of Apple. Making sense, right? So one contract holds 100 shares. That's what a contract size means, right? Every contract is equal to 100 shares for stock options. Okay. So for each contract, for each option contract, the option buyer reserves the right to buy or sell 100 shares of the underlying security at the strike price specified by the expiration date. So think about this, same thing, right? So this is a sneaker, one contract of sneaker, NKE sneaker, all right? Travis Scott sneakers, $300 the strike price. That means you have the right to buy 100 sneakers at $300, right? That's the strike price. So one contract is equal to 100 shares. And in sneaker terms, it's 100 sneakers. And if you have 100 Travis Scotts, I'm going to come to your house and steal some. Okay. So stock option contracts sizes are defined by the options exchanges, right? So no one decides this one contract is equal to 100 shares except the options exchange, right? In the US, it's Chicago Board of Options Exchange, CBOE. They decide what the contract size or lot size is, right? One contract is equal to 100 shares. Okay. And then if you're trading in the US, you don't have to worry because all stock options is equal to 100 shares, right? And the next is option premium, right? So what is option premium? Option premium is the price you must pay to purchase an option contract, right? So I mentioned about contracts here. I told you that Barry and Sam, hey, he's getting into a contract, right? These guys are friends. They're getting into a contract. Sam is agreeing to sell the sneaker for $300 by September, right? Now, what does Sam get out of this? You need to ask yourself, right? What does Sam get out of this deal? He is not an idiot, right? Sam needs something in return to get into this deal. This is business at the end of the day, it's business, right? So for Sam to agree to this contract, he needs to receive something, okay? That is what we call as option premium, right? Option premium is the price you pay as a buyer to purchase the option contract, okay? So Barry will have to pay a certain amount, right, to Sam for him to agree to get into that contract with them. Right? So option premium is the price. If you're a buyer and you want to get into and buy an option contract, you have to pay a certain amount, right, to purchase that option contract. Now, option premiums are quoted on a per share basis. So if you open your brokerage app, right, and let's say Apple $120 call option is priced, you see it in the options chain, it's just $2.25. Oh my God, it's just too good to be true, right? $2.25. Like I can buy like so many contracts. That's what you would think. But option premiums are quoted on a per share basis. And I told you that one contract is equal to 100 shares. So 225 into 100 is the price you have to pay for an option contract. So $225 is the price you pay for one Apple call option contract. Okay, $225. Is everyone getting? So one contract is equal to 100 shares. So whatever, if you want to purchase an Apple call option, one contract of Apple call option, you have to pay $225 per contract. Okay, is everyone clear? So if you see a number like this, know that you have to multiply it by 100. Okay, Monica said she does not understand. So let me go over it again. So backing up, right? If you want to buy an option contract, open your Thinkorswim app and you want to buy a call option contract or a put option contract or whatever, right? You have to pay a certain amount. Okay, It'll be $100, $200, whatever it is, right? And in this example that I'm showing you, I'm saying Apple $120 call option costs $2.25, right? Now that's not literally $2.25 because one contract is equal to 100 shares. So you have to multiply whatever you see there into 100, and that's the price you have to pay for the option contract. Now you don't have to do the math. Your brokerage app will do it for you. So you can just hit buy and you can get it, right? But I just want you guys to know how this price is calculated. Okay. Yeah, $120 is the strike, Ryan. Yes, you are right. $120 is the strike price in this example. Okay. So that's option premium. Option premium is nothing but the price you have to pay to purchase an option contract. And next is expiration date, right? Day the option contract expires, right? Correct. Mike Cooper, yes, 300. If the sneaker example is good, but I wouldn't really buy 300 into 100, right? That's just the daylight robbery, right? So expiration date is the day the option contract expires, right? Most stock options have weekly, monthly, and quarterly expiration dates, right? This is the day the option contract that you have becomes null and void, right? So what do you mean by weekly? So this is a question that a lot of people always ask me, Unraveler, what do you mean by you're trading weeklies? Like, I don't see that in my brokerage app, right? Weekly means those contract expires the same Friday, right? So if I'm trading a weekly today, right, that contract expires this Friday, right? It becomes null and void after Friday. Monthly contract expires every month, right? Quarterly contract expires every quarter, right? That's how option chains are created. Okay. So what are the implications of options expiration date? What actually happens to the option contracts? On option expiration, option owners will have the following choices. You can sell the option contract to another buyer in the market and realize profit or loss. Now, this is what we do every single day, right? We buy something, we make a quick profit off of them. Like when the stock moves in our favor, hey, we make our positions up 10%, 20%, whatever it is, right? Then we sell it to another guy in the market and we realize our profit or loss, right? This you can do it on any day and you can do it on option expiration day too, right? Number two is exercise the option contract to purchase shares of the underlying security and then realize profit or loss, right? So if you have one contract of Apple, let's say you want to exercise it, so you can buy 100 shares of Apple and for that contract and exercise your option to buy, that's another option for you. Then lastly, let the option contract expire worthless, right? So this is another option for you. So if you bought something and the stock does not move in your favor, and you can't sell it to another buyer in the market because the contract is literally zero, then you can let it expire worthless. Okay, so these are the three things that can happen on option expiration date. Okay, now an important note, US stock options can be exercised anytime before expiration, right? Now, this is not true for certain countries. If you trade in the UK, if you trade in India, if you trade in Australia, right, you cannot exercise an option before expiration date, right? The US is different. You can exercise it whenever you want, right? So if Barry decides to say that, hey, it's only August, but I really like that sneaker, I want that sneaker, he can buy that sneaker, right? Whenever he wants, right? Because that's the option he has. Okay, but if Barry is in the UK, then he can't exercise it until expiration. Okay. All right. So the next is, so we're done with the basics. Are you guys keeping up? Are you guys good? Somewhat understand? Yes. So now we're going to come to the good stuff. So now you know what a strike price is, you know what an option premium is, you know what an expiration date is, you know what an option is, right? You know what a financial instrument is. You guys already know a lot of stuff, right? Now let's come to the good stuff. Types of options, right? Two types of options available. Call option, put option. I've colored it accordingly. Call is green, put is red, right? So call option, what does it mean, right? Call options give the buyer the right, but not obligation, to buy shares of the underlying security at the strike price specified in the option contract. Okay. So basically, if you have a call option, right, you have the right to buy it. So in this case, the sneaker case, Barry had a call option on the sneaker, right? He had a call option, $300 call option expiring September for the sneaker. Okay. All right. Now, investors will be able to secure profit by selling the option contract if the stock moves in their favor. That is options trading. So the basic thing about call option, the reason I colored it green is because when you buy a call option, you want the stock to go up, right? You want the stock to go up. Guys, pay attention, right? Like I see a lot of typing in the chat, pay attention, right? So if you buy a call option, right, you want the stock to appreciate in value, right? You want it to go to the moon, right? When the stock moves in your favor, you'll see some profits, so you can sell it to another guy in the market and realize your profit, right? That's what we call as options trading, right? Investors will also have the right to exercise the call option and buy shares of the underlying security at the strike price specified in the option contract. This is the other option that they have, right? If you really like the stock, you can exercise your option and buy the stock, right? That's another advantage of call options. Well, let's take a look at a real life example. Okay, so pay attention. Let's say you bought Pinterest, right? The social media company, $20 weekly call option for $2. Okay, now what does this $2 say? What is $2? How much will you have to pay? I'm asking you guys a question. If it says $2, how much will you have to pay to purchase one option contract? There you go, 200. That's exactly the right answer. So if you buy one contract, you have to pay $200. If you want 10 contracts, you have to pay $2,000, right? Now, that's how it works, right? So what does this $20 represent? What does this $20 represent? Yes, that's the strike price. Okay, pins is the stock, $20 is the strike price. What does weekly mean? Expiring the same week, correct. Okay, so let's say you bought Pinterest, $20 weekly call option for $200. And when you bought it, Pinterest was trading at $20 per share. Okay, and when you buy a call option, you stand to make money if the stock price rises. So if you buy a call option, if you even think about buying a call option, you are predicting that the stock is going to go up, and you make money when the stock goes up, right? So let's take a look at this graph here. Pinterest, the x-axis has the stock price, y-axis has the P&L, right? Profit and loss. So when you bought the option contract, Pinterest was trading at $20 per share, right? And you bought here, meaning you risked $200. So that's why it says minus 200. You gave away $200 to purchase this option contract, right? And Pinterest was trading at $20 per share. Okay. Now, as an options trader, you will start seeing profits as soon as the stock price starts moving in your favor. Okay. So take a look at this. 20, 21, 22, 23, 24. As the stock price goes up, right? Your options also go up. What do I mean by that? You paid $200 for it, right? So that same option contract, when you bought the option contract here, the $20 option call option was priced at $200. But as the stock price goes up, goes to 210, 220, 230, 240, 250, 260, 270, 280, just keeps going on, right? The same option contract which you bought is now worth $280 or $300, right? You bought it at 200, it's now worth 300. So basically your position is $100 profit. As the stock goes up, that's going to keep going up, right? The stock keeps going up and up and up. Your $200 position may be worth $400 now, right? It's going to be worth $400. So as the stock keeps going up, your options value also is going to keep going up. Why does it go up? It's a derivative instrument. It derives the value from the stock, right? As the stock goes up, options value also go up because it's a call option. All right. There you go. Now, maximum loss, right, is 200 because that's how much you put up, right? You paid 200 to purchase that option contract. So you can't lose more than that. Your maximum risk is 200, right? You can't lose more than money you put up, right? $200 is what you paid for the option contract, and $200 is your max loss, max pain, max everything, right? Now you don't have to wait until the $200 to get out, right? You can cut your losses if things go sideways. Let's say you wanted the stock to go up once you got in, but something happened, someone tweeted, and the stock just started to go down, right? So if you see something's going down and you see something's happening, you can cut your loss pretty short, right? You don't have to wait until 20. You can just take a $20 loss or a $30 loss, right? You don't have to take the full loss. That's the beauty of options, right? You can get out anytime. You can buy whenever you want. You can sell whenever you want. That's the beauty of it. You can sell at 100% profit or 200% profit or 1000% profit, or you can even sell it at 5% profit, right? And you can take a 5% loss or 10% loss, right? You don't have to wait until 100% loss, right? That's how you manage risk. So we're going to talk about a lot about risk management, right? Trading is like 50%. You can you'll learn all of this stuff. It's money management is what it's all about, right? You have to learn how to manage your risk, right? You're not going to be right 100% of the time. You're going to be wrong a certain percent of time. You have to make sure that your losses are very small, right? Okay. So as an options trader, you'll start seeing profits as soon as the stock starts moving in your favor. You can sell your contracts and secure your profits at any given time, right? For exercising your option contract, the break-even price is $22, and at expiration, if pins is trading at 24, you stand to profit 200. You don't have to worry about this part, right? It's for exercising of the option contract. We're strictly going to talk about day trading here today. Okay. Does everyone understand what a call option is? Right? Basically, you buy a call option when you think the stock price is going to go up. When the stock goes up, your options go up with it, and you can make money, right? All right, guys, some of you are asking like advanced questions, right? I will explain that all in a future lesson. Today, it's all about getting started, right? You guys are asking good questions just at the wrong class, right? Some of you are already familiar with options, totally get it, but I'll answer your questions pretty soon, okay? So second type of option is put options, right? Put options gives the buyer the right, not obligation, to sell shares of the underlying security at the strike price specified in the option contract. Now, put option is if you're a new trader, especially most traders, right, when they're starting out, they hate put options, right? They don't like to trade put options because it's, first of all, it's red in color, right? Like who likes red? Everyone likes green, right? So the thing here is that you can make money in the stock market when the stock goes up and also when the stock goes down, right? And investors buy put options if they believe the stock price will fall by a certain amount by expiration date, right? So if you think the stock price is going to go down for Amazon or whatever stock, right? GME, AMC, right? Then you can buy put options, right? You can profit when the stock is falling, right? So investors will be able to profit by selling the option contract if the stock price moves in their favor. That is what we do. If we think a stock is going to go down, we buy put options, we ride the wave, then sell it to another guy in the market, and then take profits, right? And then investors will also have the option to exercise the put option and sell shares of the underlying security at the strike price specified in the option contract. Now, if you have 100 shares of, let's say, Tesla, right? And you have a put option contract, and after earnings, Tesla tanks, right? If you have a put option contract, you can sell 100 shares of Tesla at the strike price specified in the option contract, right? That's a cool thing you can do with put option, right? It's the option exercising, right? And one important thing I want to call out before I jump into the example is both the call options and put options are available as stock options, index options, future options, and currency options, right? Stock options is what we trade every single day, right? These option contracts, these derivative option contracts track the stocks, individual stocks. Index option tracks the indices, SPX, S&P 500, right? NASDAQ, the Russell, right? Dow Jones, right? The index option track the indices. Future option tracks the future contracts, right? Future market. Currency option tracks the Forex market, right? Now we're only going to focus on stock options in this course, right? These are all also available and they follow the same concept. Remember, derivative instruments is the same. Call options, put options is the same across different asset classes, right? But we're going to focus on stock options. Now, let's talk about put options. Quiz for you guys again. Let's say you bought Uber $40 weekly put option contract. What does the $40 represent here? What does it say? Strike. And just keep asking you so that you guys, it'll just get edged in your brain. What does weekly represent? Same week. Yes, there you go. And when do you buy a put option? Yep, it goes down. When you think the stock is going to go down, you buy a put option. And $3, what does it actually represent? How much would you have to pay? $300. There you go. All right. So let's say you bought Uber $40 weekly put options for $300 when Uber was trading at $40 per share. When you buy a put option contract, you stand to make money if the stock price falls, right? So Uber is $40 here. You bought a put option here. You think that Uber is absolutely just going to tank, right? Because Uber is not paying their drivers properly or something like that. And you think that, COVID is going to cause a huge, put a huge dent in their revenue because travel restrictions or whatever your use case may be, right? You think the stock is going to go down. So you buy a put option, right? Now, Uber starts selling off 39, 38, 37, 36. As the stock price drops, the put options value increases, right? It was initially $300, but now it's worth $600, right? So you make a $300 profit off of that. As the stock drops, your put options value appreciates, right? And the maximum loss you can incur for this is $300 because that's the price you paid for the option contract. Okay. So now you guys understand, right? If the stock goes up, when you have a call option, your option goes up, right? And if you have a put option contract, right? You want the stock to go down. And if it goes down, your option increases in value, right? So you can make money when the stock goes up and you can make money when the stock goes down, right? So pretty easy, right? You just have to bet on the right stocks. You're using technical analysis. That's what we're going to learn in AMU. And you can make money off of options, right? And you're going to be able to control your losses by following good risk management. That's all options trading is about, right? Buying the right stocks, buying at the right time, selling at the right time, and controlling your risk and managing your risk, right? And that's what we're going to learn in AMU University, right? So break even is a concept you don't have to worry about right now. It's for exercising the option contract, right? It's related to exercising the option contract. We'll learn in a future lesson. Okay. If I explain break even now and I've done it in the past, many of you will not understand this, right? So now we're going to talk about strike prices a little bit, right? We're going to talk about strike prices a little bit. ITM, ATM, and OTM strike prices and options, meaning in the money, at the money, and out of the money strike prices and options. All right. So this wonderful picture here is what we call as an options chain, right? So this is a screenshot taken on 4/17/20. The screenshot is from barcharts.com, right? BARCHARTS.com, right? So this is a website that has a lot of information on options, data, and statistics, right? So Baidu, the stock was trading at $105 a share, right? Bar charts, BARCHARTS, charts, bar charts. Yes. All right. So Baidu was trading at 105. All right. So this is what we call as an options chain, right? The left-hand side, you have all the call options, right? You guys can see it. It's colored green and nice and everything. And the right-hand side, you have all the put options, right? So if you want to buy calls, you think the stock is going to go up. If you want to buy puts, you think the stock is going to go down, right? In the middle, you have strike prices, right? So 97, 98, 100, 105, 10, 15, 20. It just keeps going on, right? So what I want to show you guys, what I want to tell you guys is what is in the money, at the money, and out of the money strike prices and options, right? So we will go over this concept in detail when I go over options Greeks, but I want you guys to understand the concept of in the money, the concept of at the money, and the concept of out of the money, right? So what does in the money options mean? Okay. So a call option is considered in the money, the stock price is greater than strike price. And a put option is considered in the money if the current price of the stock is lesser than the strike price. So let's forget the definition. I'm going to talk about some real examples. Okay. Current price of Baidu is $105. Okay. Now look at all these strike prices within this green box, right? 104, 3, 2, 1, 100, 99, 98.5, 98, 97.5, 97. These are all lower than the stock price, right? Now, if you have the $100 call option for Baidu, what does that entail you, right? What can you do with the $100 call option? If you exercise that option, you have the right to buy a share of Baidu at $100 per share, right? If you have a $100 call option for Baidu, you have the right to buy Baidu at $100 per share, even though the stock price is $105. You can buy it for 100, even though its price is at $105 in the current market. Meaning these options contracts are already profitable. They're in the money, right? Remember, if someone says in the money, it's already profitable, right? These option contracts are already in the money. They're already profitable. If you just confused, just compare it with the stock price, right? You have $100 call option. This thing is 105. So this thing is clearly already in the money. Is everyone clear on this? These options are called in the money because they're already profitable, right? Okay. Now, same for put options, right? 106, 7, 8, 9, 10, 11, 12, 13, 14, right? These put option contract strikes, right? If you just compare it with the stock price, they're greater. The strike price is greater than the stock price, right? What does that mean? So let's say you have the $110 put option for Baidu. That means that you have the right to sell Baidu at $110 per share, right? This is a put option, guys. No, this is not out of the money. This is a put option. I'm just talking about in the money option. We discussed call option. For put options, if you have the $110 strike for Baidu, it gives you the right to sell Baidu at $110 per share, even though the stock is only trading at 105, right? The stock is down, but you have a strike greater than the stock price. So you can sell it at $110 per share and then make a lot of money, right? Puts means selling, calls means buying. Okay. Hope that makes sense. So if a put option is to be considered in the money, it has to be, the strike price has to be greater than the stock price. Okay. These are all in the money put options, and these put options are already profitable. Okay. Is everyone clear on what the term in the money means, right? I don't want you to understand why should we trade in the money? Why should we trade out of the money? Why should we trade at the money? Don't worry about that right now. I just want you guys to understand what in the money means, right? I will teach you what kind of strike price to select, when to select it, and why you should select it in a later lesson, right? Don't worry what to select. I don't understand this and all of that. I just want you to know what ITM means, right? Just that's it. Okay, Valdez wants me to explain again. Sure. So current price of Baidu is 105. Okay. Let's say you have the $100 call option. Okay. $100 call option means you have the right to buy Baidu at $100 per share, right? Even though the stock price is trading at 105, right? Meaning you are able to buy it at a discount at $100 per share. Okay. That is why these options are considered already profitable. If you have the same sneaker example, guys, the sneaker, you have the $300 sneaker, a call option contract, but the sneaker is worth $3,000, right? So that sneaker is already in the money because it's already profitable, right? Okay. So basically, if you have some contract that's already in the money, that just means that it's already profitable and the stock price is greater than the strike price, right? For put option, same concept, right? It's just the terminology. Exactly. It's just the terminology, right? These put options are already profitable, right? But the terminology part is what confuses a lot of people, right? Short calls were price going up. That's exactly it, right? These call option contracts, right? Think of it like this, guys. These are only ITM, ATM, and OTM. They are just different terms for different strike prices, right? So this particular set of strike prices are called in the money because these options are already profitable, right? This set of strike prices are called in the money because these are already profitable, right? Now let's talk about out of the money. Maybe you guys will understand once I go over out of the money, right? So out of the money call options, right? A call option is considered out of the money if a current stock price is under the strike price, right? So let's take a look at these stock prices, strike prices, right? 106, 7, 8, 9, 10, 11, 12, 13, 14, and goes on, right? If you compare it with the stock price, right? If you compare it with the stock price, the current stock price is 105, right? 106, 7, 8, 9, 10 are future prices. The stock is not trading at those prices, right? So if you think Tesla is worth 750 and you buy a $750 call option, Tesla is only trading at 710 today, right? You're buying something $40 out of the money, right? Tesla's future price is 750, but Tesla is only trading at 710 right now, right? That's why we call it as out of the money, because it's $40 out of the money. It's a future. If you compare it with the current price, it's $40 out of the money, right? Now do you guys understand this, right? Out of the money means it's a future price, right? In the money means the stock is already profitable. The option is already profitable, right? That's all you need to think about, okay? Same thing for put options. 104, 3, 2, 1, and 100, and so on and so forth, right? These options are under the strike price, right? These are all future prices. When you buy a put option, you think the stock is going to go down, right? You think the stock is going to go down. Current price is 105, 104, 3, 2, 1, 100, 99, 98. These are all future prices, right? These are all future prices. You think the stock is going to go down, but it's still at 105. It may go down to 100 in a week, but that is still a future price, right? Yeah, just rewatch the lesson, guys. These are all terminologies, but you will get confused, okay? I'm going to lay it straight to you guys. You will get confused by all these terms, right? It's Wall Street guys, they made these terms just to confuse you, right? In the money means it's already profitable. These options are already in the money. Out of the money means these are future prices, right? But you will get the hang of these things as you just keep looking and reading, and voila, one day you'll get it all, right? These are just nothing but terminologies, right? Just have to understand this and you will understand it, okay? And next is at the money, right? So at the money means stock price, strike price, near the same, right? In and around. So everything around this is considered actually at the money, right? In this example, I just had a perfect example. So 105 strike price is at the money, right? Okay. Now, I know some of you will have the questions of which strike should I select. Don't worry about it now. Okay. We'll talk about that later. Okay. So now we're going to talk about options writing. So if you thought the first part of the lesson was hard, this is going to be even harder, right? But this is not something that you have to know from the get-go, right? You will learn about options writing and credit spreads, debit spreads, and all of the different option strategies later in the course. But you don't really have to know to day trade and make money. This is more of a general knowledge for you guys, so don't be overwhelmed, okay? But pay attention though. I don't want you guys to sleep this part of the lesson, right? So what is options writing? Options writing is a strategy where an individual writes or sells an option contract to a buyer in the market to collect the option premium. So basically, I'm going to be Sam. What did Sam do here? He just wrote premium contracts. Hey, I'll sell you a sneaker for 300. I'll sell you another sneaker for 300. Hey, I'll sell you another sneaker for 300, right? That's all he did. And he basically collected premium for all of those contracts, right? So everybody paid him the option premium, 300, 300, 300, whatever the premium was. Sam collected the premium and he promised everyone a sneaker, right? Okay, that's basically what Sam did. Sam did not do it for free. He wrote those option contracts and he collected the premium, right? So options writing is a strategy where an individual writes or sells an option contract to a buyer in the market to collect the option premium, also known as the fees, right? When an option writer writes an option contract, they are obligated to buy or sell, depending on the type of option, the underlying security at the strike price, should there be an assignment. So I want you guys to understand one main concept, right? There are option contracts in the market, right? Call options, put options. So for any of the option contracts, there has to be someone that creates those option contracts, right? Someone has to create all of this for anything to be traded. Someone has to be, think about a document, right? So you have a document in place in your office, in your 9 to 5 office, right? there is a piece of paper, someone has to type it everything in to make that document a legal document or something like that, right? And someone's going to read it and someone's going to sign it, right? Someone's going to be the receiving part of it and someone's going to be the signing part of it, right? But someone has to create the contract, right? In the first place, someone has to write that contract, put it in the right words and create that contract. And that's what we call as options writing, right? Call options, put options, whatever it may be, someone has to create that option contract. And you as an individual can create a call option contract. If someone on the market wants to trade that call option contract, they can purchase it from you for the option premium. Okay. You will be collecting the option premium and basically agreeing to buy or sell depending on the type of option contract, the underlying security, the strike price, should there be an assignment. Okay. I'm going to give you guys some examples in the next slide on what kind of implications that will have. But this is how the hierarchy of options. So options, you have buying and you have writing. So far in the lesson, we've only been talking about buying, right? We talked about buying call options. We talked about buying put options. So basically, if you can buy a call option, you think the stock price is going to go up. And once the stock price goes up and you're seeing some money, you can sell it and secure your profits. And for put options, you buy it when you think the stock price is going to drop, right? And if the stock price drops, just like that Uber option contract, you can make money, sell it to another guy in the market, secure your profits. Is everyone clear on this concept so far? Buying and selling, right? Calls and puts. Yes, right? This part everyone's clear. Now, writing is just the other side of the transaction. There are like two sides to the same coin, right? Writing is the other side of the transaction. So writing basically is classified as two sides, right? Calls and puts writing. There's covered writing and naked writing, and covered writing and naked writing, right? Okay, so let's discuss this. So writing call options. When writing call options, the writer collects premium and agrees to sell shares of the underlying security at the strike price specified in the option contract should there be an assignment, right? So basically, let's say I'm writing an call option contract, right? Someone is giving me the premium. So let's say I collect a $200 premium, right? So when I collect the $200 premium, I have to agree to sell that. Hey, if someone on the other person that buys the contract exercises that contract, I have to sell them something, right? So in the sneaker example, right? Sam, what did that guy do? He had a Travis Scott sneaker. So he wrote an option contract, collected a premium and promised a lot of people. Basically, he promised Barry that he'll sell that sneaker for $300 by September, right? He said that he'll sell that sneaker for $300 by September. Now, Barry, if he said that, hey, I want to exercise my contract and buy the sneaker from you for $300, Sam is obligated to give him the sneaker for $300, right? Is everyone following? So when you write a contract, you're obligated to fulfill that obligation, right? So in your contract, you say that, hey, I'm going to sell you the sneaker. Then if the other guy asks you, then you have to sell the sneaker, right? Because you put it into agreement. That's the contract and options, right? If you writing a call option contract and the other guy says that, hey, I want to buy 100 shares of Apple from you because you said that you would sell it to me, then you have to sell him 100 shares of Apple, right? So that's writing call option. That is the obligation that is tied to when you're writing call options, right? So this is a graph I actually put together for you guys, right? So when you're a buyer, right? Buyer has the right to buy the stock. You want the stock to appreciate in value, meaning you want stock price to go up, and buyer pays the premium, right? But if you're the seller, also known as options writing or a writer, right? Seller has the obligation to sell the stock, right? You want the stock to depreciate in value, meaning when you write an option contract, you basically want the option to go to zero, right? You don't want to fulfill an obligation. So all these guys just want free money, right? They're writing this contract. They want the options contract to go to zero. They don't want the buyer to exercise their contract. They want it to expire worthless so that they can just keep the premium, right? This is what market makers do. They sell you all the contracts and they try to make sure that all these option contracts expire worthless so that they can just keep the premium, right? So that is a seller's wish, right? Now let's go over this example, right? No. I'm coming to that, right? So Apple naked call options, right? So what is a naked call option? First of all, let's assume John wrote Apple $300 call option contract expiring 5/15 and received a premium of $400, right? So let's break this down. John, this guy, wrote one contract of Apple $300 call option contract expiring 5/15 and he received a premium of $400. Okay. On an option expiration date 5/15, let's say Apple gapped up $10. Apple closed at 310. Okay. He wrote the $300 call option contract and Apple closed at 310, right? So the call option contract is in the money, right? You guys can see this, right? $300 current price of the stock is 310. The call option is 300, right? This 300 contract is already profitable, right? Since this guy sold it, since John wrote this contract, and since this contract expired in the money, someone out there will exercise that contract and buy shares of Apple for $300, right? So John is obligated to sell 100 shares of Apple at the strike price specified, that is $300 per share, assuming John is assigned, right? So what do you mean by naked call? Naked means John does not have 100 shares of Apple to sell, right? John wrote a $300 call option contract thinking that Apple is going to go down. Basically, what John wanted was Apple to expire below 300, right? He wanted Apple to expire under 300, right? 299, 298 or something like that, so that this call option contract will expire worthless and he can just collect the premium, save the premium of 400, right? But since this guy went up and screwed John, Apple closed at 310, the other guy is going to exercise his contract, and John is obligated to sell 100 shares of Apple at 300 per share. It is called naked because John does not have 100 shares of Apple, right? So what John will have to do to fulfill his obligation, he'll have to go to the market to buy 100 shares of Apple at the current market price, right? So John will go to the market, buy Apple for $310, right? And then sell it for $300. So basically 310 minus 300 into 100 shares is what John will lose on the trade, right? So 310 minus 300 is $10, right? 10 into 100 is 1,000, right? So $1,000 is how much he lost because this contract expired on the money. But if you subtract minus 400, which is the premium he initially got, right, for writing the contract, he just lost the $600 on that trade, right? This is the strategy of writing a naked call. And if the call expires in the money, John will have to fulfill his obligation. And in this case, he lost 600 on the trade, right? Now, since it's our first class, we're going to be talking about positive things. So basically, if Apple closed at 298 on 5/15, right? If Apple closed at 298, right, under 300, the strike price, it is expired out of the money, meaning the call option contract is worth $0. And buyer will not exercise that, and the option will expire worthless. John will just have made the profit of 400 because he wrote those contracts. So basically, it is an actual stat. 85% of all option contracts expire worthless, right? All option contracts, 85% of them expire worthless. Only a select few of them expire in the money, and only a small percentage of that is going to be exercised, right? So options writing, if you have a huge account, right, you can write all these contracts and make a good residual income, right? All these market making companies and everything, how do you think they're staying in business, right? They write all these contracts. You are willing to pay for Amazon $4,000 call options. If you're willing to pay $500, then they will just take that because Amazon is not going to go to 4,000, right? So during earnings season, all of that, Mike and I, we always do, we write options, we do credit spreads, debit spreads, and all of that, iron condors, make easy money because IV is so high and you can easily make money off of that, right? So what is the difference between writing naked and covered call option, right? Like I said already, writing naked means you don't have the share, you don't own any shares, right? But writing covered means you already have the shares. So in this case, if John wrote a covered call option, John had 100 shares of Apple with him already when he wrote it, right? So the losses may be minimized, okay? The risk associated with writing naked call option is infinite, as stocks can technically go to infinity, infinite upside potential, right? So let's say that you wrote Tesla. No, not forget Tesla. Facebook. All right. Let's say you wrote Facebook $300 call options, and Facebook reported earnings and they rallied 20%. Right. So basically, Facebook would have rallied like $30, $40, right? And the stock can technically go to infinity. Let's say Facebook unveiled some new platform or something like that, and the stock actually rallied like a crazy amount, right? Your loss could be infinity if you do naked, because you don't have the share, so you'll have to buy at current market price, right? Stocks can technically go to infinity. There is no roof or there is no ceiling that how high a stock can go, right? You only think it can go this high, it can even break past that and go even higher, right? So writing naked is very risky. If you don't know what you're dealing with, your risk could be infinite. Okay. Writing covered is a strategy of writing call option while owning the underlying security. So if you have the stock to cover your obligation, you could do that at any time, right? If you have the stock, you can sell it, right? You don't have to go to the market and buy it. So writing covered is a safer strategy, right? So that's why people say that it's always safer to do covered calls. But writing, sometimes in the normal market, you don't see crazy moves like that happen that often, right? So you can do naked writing, but you got to be careful. Okay. Yeah, it all depends on the risk. And then writing put options, right? When writing put options, the writer collects the premium and agrees to buy shares of the underlying security at the strike price specified in the option contract, should there be an assignment, right? Let's look at an example here. Suppose John writes NVIDIA $300 put option contract expiring 5/15, and he collected a premium of $5, meaning $500. So one contract of $300 NVIDIA put, and he collected $500 for writing that contract, right? So on options, is that premium upfront? Yes, you will get a credit. When you write it, you will get a credit, right? On 5/15, NVIDIA closed at $290, right? NVIDIA closed at $290. Okay. It's in the money. John wanted NVIDIA to expire worthless, meaning he wanted the stock price to go up in this case because he wrote puts, but NVIDIA actually did him dirty and it dropped and it expired in the money, right? So John is obligated to buy 100 shares of NVIDIA at the strike price, $300 per share, assuming John is assigned. You guys can do the math. 300 is the price he bought it at. 290 is the current price of the stock. So into 100, that's the same $1,000 loss. That's the intrinsic value of the option. So John will lose 1,000 minus 500. It is 500 on the trade, right? 500 here is the premium he collected up front. Okay, so I lost 500 on the trade. Now, if NVIDIA closed at 310, right, the put option will expire worthless, and John made a profit of $500. Yeah, intrinsic means the intrinsic value is a concept that people say that subtract the current price of the stock with the stock price, and that is the intrinsic value. Okay, stock price minus strike is intrinsic value. Okay, so we will learn that in the next class. Okay, right. Next is naked put option writing. So naked put option involves writing put option without shorting shares of the underlying stock. The risk associated with this strategy is high should there an option not expire worthless, as technically stocks can go to zero, right? Stocks can go to zero before expiration date. I'm going to give you guys, show this example here, right? Now let's say John wrote Hertz $10 put option contract. Okay. Hertz is a company that went bankrupt, right? They filed for bankruptcy because COVID really hit their business. They had a lot of cars, a lot of debt, and they just couldn't keep the lights on anymore, right? So Hertz overnight, they dropped to $1. They dropped like 80%, 90%, right? They dropped just on one day, right? So John will have to buy 100 shares of Hertz at $10 per share, even though Hertz's price is at $1, right? That's a huge loss, right? He's going to buy 100 shares at $10, but Hertz's price is only $1. Now imagine if you wrote 1,000 contracts or 10,000 contracts, his hedge fund or whatever will have to be shut down, right? So that is how you see a lot of our funds blowing up. And when GME and AMC rallied, right? Why did it rally, right? So most of the time, these guys wrote call options. They just they just wrote call option thinking the stock is not going to go up. And once it goes up, these guys have to cover, buy more shares and shares and shares to cover, right? They have to buy to fulfill their obligation. They have to buy. That causes the stock price to go up and up and up, right? And some hedge funds are also shorting the shares and causing a huge short squeeze, right? Those are the dynamics that actually causes stupid stocks like GME to go to the moon, right? It's not like GME is a dumb company. It's a bankrupt trash company. It's not worth 150, 200 bucks, right? It's not worth that much. There are a lot of behind the scenes games going on there, right? That's why all this, crazy squeezes happen, right? Now, so this is a naked put option writing. Now, what is a covered put option writing? Now, pay attention. This may be a concept that may be a little new to even experienced traders, right? What does rally mean? Rally means stocks going up, right? Stocks going up a crazy amount. Okay. All right. So what is a covered put option writing? Writing covered put involves writing a put options while also shorting shares of the underlying stock. How many of you know what shorting means? Who does not know what shorting means? Okay, many. Okay, all right. Yeah, shorting means betting on a stock to go down, right? But what is basically, someone mentioned the Big Short movie, right? So basically, shorting means is a bearish view on a company, right? You think you see Goldman Sachs or something like that, you think that they are cooking the books or whatever, right? And you think that the stock is going to go down, right? So what you're going to do is there are going to be lenders in the market, lenders, people who lend you shares, right? People who are going to lend you shares. So basically, you're going to borrow shares, right? You're going to borrow shares at, let's say, $100 per share, right? Current price of the stock is $100. So you're going to borrow shares at $100. And when the stock falls, right? Let's say the stock falls, it falls $20, $30, right? You can give them back the shares at $70, right? So basically you pocket the difference. Okay, you're borrowing at a higher price and then covering at a lower price, right? And you're pocketing the difference. And that's how you profit, by shorting the shares. Okay, is that a simple enough explanation? Do you guys get it? Yes? Borrowing at a higher price and then returning it back at a lower price. Okay, some people said no. So let's say that you have the current price of the stock is $100. Okay. When you short something, you go into a minus position. Okay, you're borrowing it. Okay, so you borrowed some shares at $100 per share, right? And the stock, let's say it dropped $20 or $30, right? Drops 30%. Okay. Now, hey, this thing has dropped 30%. So what I'm going to do is I'm just going to return this back and cover the difference. So you're just borrowing the shares. You're not borrowing it at this price, right? So you can just return it back and pocket the difference. That is the cool thing about it. Okay. Yeah, you make 30 on the 100, correct. Mark Mendoza, you make 30 on the 100, right? You borrow at 100 and return the same thing back and you make the profit the difference, right? That is shorting, okay? Now, this covered put option writing means you're writing a put option contract, right? And you're also shorting shares, right? Shorting has nothing to do with options. You're shorting the shares itself, right? It has nothing to do with options. You're shorting shares, right? You're writing put options and are also shorting shares. Okay. Now let's assume this. Let's talk about this example. Maybe it'll make sense. Let's assume AMD stock is trading at $45 today. So AMD was a $45 stock last year, right? Okay. And now it's like trading at 115. Crazy, right? So let's assume AMD is at $45 today, and John writes a $45 put for a $200 credit. Right. So John wrote a put option contract and received $200 for that. And then John also shorted 100 shares of AMD at 45, meaning he borrowed 100 shares when AMD was trading at $45 per share. Okay. Pay attention. He borrowed 100 shares at $45 per share. Okay. So that means that position is worth 4,500 in the negative. Okay. Next. The net credit taken to enter this position is $200. So that is the credit he received, and that is also the maximum possible profit. Okay. How do you borrow, right? So your broker, right, will allow you to short shares if you have a good broker, right? So you can basically hit sell and you can short a share. Instead of hitting buy, if you hit sell, you can short a share, right? Anyway, so scenario one, AMD is trading at $40 per share, right? Yeah, that is advanced. Yeah. So AMD is trading at $40 per share at expiration, right? AMD was 45, it dropped $5, and now it's trading at 40. Okay. The short put will expire in the money. You wrote a put option contract, the stock dropped, so now it's in the money and is worth $500. Okay. But this loss is offset by the $500 gain in the short position. Okay. Now pay attention. I'm going to show you something, right? So this $500 loss, right? 45 minus 5 into 100, right? That's what we did here, right? Strike price minus the spot price. Strike price minus the spot price. 45 minus 40 into 100 shares. It's 500. So the short put will expire in the money and is now worth $500. But I did a smart thing and I shorted 100 shares of AMD at 45, right? So since I have shorted at $45 per share, the share stock actually dropped $5. I made $500 because of my short position, right? So 5 into 100 is $500, right? So 45 minus 40 into 100 is $500. So both this 500 and the $500 gain will cancel each other out. And the profit I made is still the initial $200 taken while entering the trade. So this is something that people do, right? Right? As a security, right? As a covered call option offers you the security, right? The same way covered put option offers you the security. If the stock actually drops a crazy amount to zero or something like that, right? People short. So market makers, what they do is, right? If they wrote a lot of put option and some bad news is happening in the market and everything is selling off like crazy, right? What they're going to do is they're also going to short shares, right? Yeah, it's hedging, right? They're going to short more shares. They're going to short a lot of shares to offset the risk that they have, right? Because if everything expires in the money, then they're screwed, right? Of all these market makers are screwed. So what they do is they keep shorting shares to make sure that their risk is, back to neutral, right? Okay. Scenario 2 is AMD trading at $55 at expiration. At this price, the short put will expire worthless. So basically, AMD went up, the put is expiring worthless, so no loss there. But the short position taken, right? AMD stock, if you guys still shorted at $45 per share, suffers a $1,000 loss because AMD rallied $10 more. You shorted at $45 per share, so you take a $10 into 100, it's a $1,000 loss, right? But the cool thing about this is you can cover your short position at any time, so you don't have to wait until the stock hits a $1,000 loss. You can cut it at a $5 loss or $3 loss, right? Yeah. Okay, yeah, definitely rewatch this last portion, right? This is not an easy concept, especially on your day one, right? Writing options is not that easy, but it's a nice to know when you're starting out, right? But once you gain enough experience, you can really use this to your advantage and make some good plays during earnings. And once if you have a large enough portfolio, you can make a lot of money just by writing. Okay, don't worry if you didn't get it, but definitely rewatch and save your notes because it can be very, very helpful to make a lot of money, small money, but consistent money in the future. Okay. Last slide here. Why do we trade options? Number one, you can generate income through options writing, right? Like I said, 85% of the options expire worthless, right? So if you learn to be smart about this, you can make small money, consistent money just by writing options, right? Number two, you can hedge your portfolio against major events like earnings, elections, etc. Right? So let's say you have a $1 million portfolio, right? Tomorrow, they're going to decide if Donald Trump or Joe Biden is going to be the president, right? You don't know how the market's going to react, right? Stock's going to go up, stock's going to go down, right? So basically, if you have a large portfolio, you can buy put options, right? You can buy some put options. If you think the stock market is going to crash, you can buy some put options to make sure that even if the stock market drops, right, your put options are going to make money, right? So that's basically hedging means balancing each other out, right? You're basically covering. So if you think the stock is going to go up long term, but in the short term, it's going to go down. You want to capitalize on the short term. So you hedge by buying puts and make money on the short term. Okay, so that's what, in an easy way, that's what hedging means, right? Can you cover your call whenever you want? Yes, you can. Yeah. Return on investment is higher when trading options. Higher percentage of return for a small move in the underlying security, right? So the main reason all of us trade options is because if you want to make money trading shares, right? Let's say you want Apple shares $125, you buy 100 shares of Apple, right? Is at $125 per share. For every $1 move, you only make $100, but you're putting what? To $12,000 nearly capital, right? That's a lot of money just to make $100. If you're investing $13,000, $15,000 just to make $100 profit, that's kind of a lot of risk, right? You're putting up you need a lot of capital. But the same thing, if you're just buying options, right? If you're just buying a $200 option contract and the stock moves a crazy amount, you make $100 return, then you made a $200 return on a $200 investment, right? So return on investment is much higher when trading options, higher rate of return and for a smaller move in the stock. And that's the main reason that we trade options, right? And the maximum loss is also capped when buying options, right? You can only lose what you paid in premium, right? That's another reason. So if you're investing $12,000 in a stock and the next day the stock goes to zero, you get zero, right? But if you just invest $200 in an option, and the next day it goes to zero, it's fine, right? You only lost 200, not 12,000, right? $200 feels a lot much smaller than 12,000, right? And the contrary to popular belief, you can only lose what you paid in premium, not more than that, right? Okay, that's the main reasons that we trade options, guys. And all of you know that we're primarily day traders. So we'll learn all about the scalping techniques, bounces, rejects, breakouts, all of that later in the lesson to the course. But I hope that you guys enjoyed lesson number 1 about options, financial instruments, call options, put options, strike prices, and all of the good stuff. Remember the Travis Scott sneakers. And now it's time for questions. Thank you all.
All right. Who enjoyed day 1? So much information still coming, guys. So don't worry. If you have questions about like the level 2, which I was talking about, I'll be talking about that.
Yeah, today's just day 1, guys. We don't want to overload you with stuff, and I know you guys already feel overloaded. So don't worry, we have a lot of stuff coming our way. All of your questions will be answered in due time.
Any questions regarding today?
Is shorting even worth it? Yes, definitely worth it. Stocks don't go up all the time, Robert. Stocks go down a lot too, and when they go down quick and fast, and you can make a lot of money.
Yeah, so I was gonna say, yes, we got a lot to go. We got week 1, week 2, week 3, and week 4 to show you guys. So, like they said.
Yeah, recordings will be posted tomorrow, Trent.
Yep, recordings will be posted.
When the contract expires in the money, does the broker automatically exercise those contracts or do they expire? So that's a good question. So if you have enough capital in your broker, usually they exercise it and you will have the shares.
Victor, don't worry. We'll be talking about the bounces.
Your advice on IB. I use IB, Ginger. It's a good platform.
Yeah. The recording will be in that Thinkific website.
Mohammed, yes, we will go over scalping and day trading in depth. Is there a test? Yes, Tanner. Small accounts, what's the best platform for day trading? I would say Thinkorswim if you're starting out.
Thinkorswim or Tastyworks.
Yeah. What is the process for picking the stocks? Donnie will go over that later.
TradeStation is good too, but I think it's 2,000 minimum.
Yep.
Thoughts on Webull? It's a good starting platform. It's decent enough. I mean, platform, you can just learn all the concepts, guys. So you won't have find too much of a difference trading in any of these platforms when you're starting out, right? Learn the basics first. And once you scale up and you feel like your platform is limiting you, then you can, explore more advanced platforms.
Right.